If you've been taking trades that seem to stop you out and then make big moves into your profit target, and it just seems like the market is against you, chances are you simply don't understand what is liquidity. In this video, I'm going to simplify liquidity for all trading strategies to help you become a more profitable trader. In this video, we're going to be going over what is liquidity, and I'm going to try to simplify it to the best of my ability to help you understand how to use liquidity within your own trading strategies. Now, liquidity is very important for every trading strategy, but before we get into how to use liquidity for different trading strategies, we need to understand what liquidity is. So the basic definition of liquidity. Liquidity refers to the level on a chart where transactions are placed in financial markets by institutional and retail traders. For most traders, it's super important to understand that retail traders, which is us, we don't make up that big of a portion of liquidity when it comes to actually moving charts. For example, if you're trading SPY, Apple, Tesla, US 30, anything like that, retail traders are not the ones that are moving the stock with a lot of volume. What's moving the stock is where the institutional traders put their buy and sell orders. Therefore, we must try to mimic and identify where those orders are, and this will help us tremendously when we are actually buying and selling into our profit targets or putting our stop losses or even entering the stock. And that's why it's super important to understand liquidity, and this was the most basic definition I could give you. Now, why is this important? Like I said, liquidity plays a crucial role in determining where we as retail traders set our stop loss, and it influences our trading strategies. Each trading strategy works because of two things: volume and liquidity. Without volume and liquidity, you simply cannot trade your strategy. So there's three different types of liquidity we'll talk about in this video. This is because these are the most important, in my opinion, for most retail strategies. Most of the trading strategies you're trading will most likely have one of these three liquidity zones. Now, there's much more advanced liquidity concepts that we can talk about, but that's going to be for a later video. In this video, I want to ensure you understand liquidity and the main concepts. So number one, support and resistance liquidity. This liquidity occurs when there's equal highs and lows, and these act as magnets for price. These create support and resistance level that impact market movements. We'll talk more about this when we see real examples on the chart later in the video. However, for support and resistance liquidity, it is important to understand that most retail traders, when they think about liquidity, it will be that support and resistance liquidity, and they will be putting their stop losses based off of that support and resistance liquidity. Number two, trendline liquidity. Trendlines are used by retail traders to identify liquidity levels that become targets for price movements, influencing trading strategies. Now, trendline liquidity is something you need to understand if you're trading a flag pattern per se, or if you're trading any type of pattern, right? This could be a flat top, a double top, right? Any sort of pattern. That trendline liquidity is super important to understand, and we'll talk more about that. Now, of course, this is more used for retail traders because big institutions are not waiting for trendline breaks. However, if you understand trendline liquidity, you'll understand the concept of putting your stop loss in a better position than where you naturally would have, and we'll talk more about that. Number three, liquidity fakeouts. Now, this is a super important concept to understand, and we'll talk about this and how you can stop getting faked out on most trades. If you've ever been in a trade and you put your stop loss where you believe market structure would have broke, however, the stock came down, is sliced into your stop loss, you stopped out of the trade, and then it decided to do a 90-degree reversal to the upside, this most likely means that you were a part of a liquidity fakeout. This happens when price fails to hold specific levels and fake out traders only to move back above that level to make new high of day or low of day, whichever direction you are trading. We'll talk about how to identify liquidity fakeouts and how to best put your stop loss based off of different liquidity levels. So, like I said, why is liquidity important for trading strategies? Well, it's because of these three reasons. Big price action moves. You need liquidity to have big moves in the market, right? You've heard of the word short squeeze. A short squeeze is basically just a big increase of the stock price while there's a lot of big institutional traders shorting that same stock. And now, because short sellers have to buy the stock to cover their short positions because they need to mitigate their risk, the stock keeps making a big move to the upside. For retail traders, whenever someone thinks about short squeeze, most people think about the GME and AMC era. But this short squeeze only happens when there's enough liquidity within stocks. If there was no volume and if there was no liquidity in that stock, a short squeeze can occur. And that's why you always want to trade stocks with high liquidity and high volume. Number 2, slippage and liquidity. The less volume / liquidity, the more chance of not getting your order filled. If you've been trading for a while and sometimes you can't exit your position fast enough on the bid or the ask, this most likely means that you're trading an option contract or a stock that has no volume. Because of this, no one else is looking to buy that stock and therefore you're not getting filled. I always recommend to students, ensure that the stock or option contract you're playing has over 1,000 volume traded within the day. And if you're trading stocks, ensure that it's a high volume traded stock. For example, Tesla, Apple, SPY. Those are the ones that I like to stick with. Number 3, liquidity risk management. The less liquidity in a stock, the harder it is to exit the stock. And this will result in worse price action. If there's no liquidity or volume in a stock, even if you have the best pattern setting up, let's say you have the best bull flag you've seen on a higher time frame, and you know if this breaks, this will make an extremely big move to the upside. If there's no volume or if no one else sees it, no one is going to be buying that stock. Therefore, even if it has the best pattern setting up for retail traders, no one is buying that stock because there's no liquidity. Okay, so if it does break that flag pattern, it will simply fail. That's why you need to only trade stocks that have high liquidity and high volume. Now that I've helped you understand what is liquidity, why it's important, how it ties into volume and trading strategies, let's go look at 3 real examples of the 3 liquidity types that I mentioned. Here we are on SPY. This is going to be the support and resistance liquidity. And what we're looking for here is this pre-market high resistance. And then we see this level of support being formed at 445.90s during pre-market as well. This is a level of support. Now, what I would be looking for in this example would be for the stock to break over one of these sides and then retest. The reason why we're looking for a retest of the stock is simple. For example, if we're looking at pre-market high in this scenario, if we break above this pre-market high and then retest, this means that on this retest, because it's pre-market high, there was selling orders here, right? And since we broke that pre-market high and are retesting, the breakout buyers that were actually breaking the stock out, they still have orders placed here because this is the lowest risk entry for the stock to continue its move to the upside. And therefore, there's going to be buying liquidity near these levels after we break that resistance. Before then, we actually have selling liquidity, right? So you need to understand that there's selling liquidity at resistance before we break. However, after we break, that selling liquidity turns into buying liquidity because the resistance turns into support. So let's play out this chart and see what happens. And right into the open, one thing that we can see is selling liquidity very, very clearly. When you have wicks on a stock like this means that there's selling liquidity, right? Because buyers are trying to bring the stock up, right? Breakout buyers are coming in, trying to break the stock up. However, with each wick that we make, sellers are trying to keep the stock below this pre-market high. Therefore, we understand that if we do break above this pre-market high, this will switch the selling liquidity we have here into buying liquidity, because this is a very clear point for most people on the chart as a low risk level if we break above this level. And right here, we can see that we are breaking out. So now we have broken out. We have closed a candle, right? And this is very important. We have a candle close above our level. This indicates that we have broken out and buyers have successfully reclaimed the stock to the upside trend. Therefore, the lowest risk entry for us and the area of the most liquidity on the chart sits still at this 446.70 retest. And right here, what do we see? We see that we broke out and here we retest. Look at how strong of a wick we put in right here, right? What does this indicate? This indicates that sellers tried to bring the stock down, but because there was so much buying liquidity near this level, buyers brought it all the way back up and closed it as a very, very strong hammer candle. Therefore, we would want to enter into the stock based off of this candle. And how would we look to enter? Well, for me, I would put my stop loss at a break of the first opening print candle. This is the opening print right here at 446.30. If we broke below this, we would come back into chop, which I don't want. So therefore, my stop loss would be there. And for my profit target, I like whole psychological numbers. If you've watched any of my videos, you understand that I like whole psychological numbers to put my profit targets at. And therefore, because 447 is very, very close to our entry, the next psychological level we have is 448. And this is where I would put my profit target. This would result in about a 2.0 trade. Let's enter into the trade here and see exactly what happens. And just like that, we reached that 448 psychological number. This was a $1,040 trade, meaning if you were to risk $500, you would have made $1,000 because this was a 2.0 trade. This is a very simple example of the support and resistance liquidity. Now let's go over to Trendline liquidity. Here we are on Tesla for Trendline liquidity. For Trendline liquidity, where do you see a trend line being formed on the stock? Well, the first thing that I see is we have a very clear downtrend on the stock. This helps us because it shows us that the trend is very clear to the downside, and therefore the trend line that we're going to form is going to be a bear flag pattern, like we can see here. This trend line has 1, 2, 3, 4, 5 touches, showing that there's a lot of liquidity sitting near these trendline areas. What would we want for an entry based off of this trendline liquidity? Well, once again, we're waiting for that retest because I'm a break and retest trader. For us, what we would be looking for is a break below this trend line and then a retest all the way back down to new lows. This is a very, very simple trade. And as a break and retest trader, right, we can trade these different types of liquidities with the most low risk possible because we understand where the trend is going, what the pattern is, and where the liquidity sits for the most high probability trade. So in this example here, we're going to have to play out the trade and see if we can get a retest of that trend line. And right here, what do we see? We see that we have some nice displacement to the downside, and now we're retesting this trend line. Because we're retesting this trend line, look, we put in an inverted hammer candle because once again, from the previous example, you see that wick, right? That wick is a very strong indication of buyers try to bring the stock up, but sellers brought it right back below that trend line because there's seller liquidity sitting near these levels, right? Before it was buying liquidity. However, once we broke below and the trend has changed, sellers are now more in control and more dominant because we broke to one side. So how would I look to enter into this trade? Well, I would look to go short on this position right here. My stop loss here would be a break of this previous lower low that we put in right here, because if we break back above this, we're also breaking above trend line again here. And then for my profit target here, you can mark out a whole psychological number. For me, we can go to that 233 whole number. This would give us a 4.53 risk to reward trade. So let's enter into a short position here and see exactly what happens. And just like that, we hit our profit target for a $1,150 gain. This was a 4.53 risk to reward trade, meaning to make that $1,152, we would have had to risk about $254 on this trade, which is very important to mention the amount of risk per trade. Now, this was a great example of trendline liquidity. Now, for the final example, let's go look at the Fakeout liquidity trade. Here we are on our final example for Fakeout liquidity. What do we see here? We see a very simple support and resistance being created on SPY. We see that there's resistance and support, and we see that there's multiple touches. This means for most people that are trading the stock, right, they're looking for simply that range, right? They're simply trading that range. Now, for us, we don't want to trade the range. We want to trade whichever way the stock wants to trend for the day. Therefore, what we're going to wait for is whichever way the stock breaks out. Sometimes what you'll notice is the stock will break out above the resistance level and then come right back down into that resistance, retest its resistance, and then make a move down, or vice versa for the support. What tends to happen here is this fake out will bring in a lot of buyers because they're buying the breakout. But because they're buying the breakout and they're not waiting for that retest where it's the highest probability entry, when we come back into that retest area and sellers do take control, well, now breakout buyers are stuck in this trade. Therefore, the risk entry for a fake out would be the retest back down to low of day. So I hope that made sense, but let's look at a real example to really amplify what I was talking about. Okay, and here, what do we see? We see the breakout, right? We see the breakout to the downside. However, like I said, I'm not a breakout trader. I'm waiting for the retest. So what we would want for a retest of simple support and resistance liquidity, like we talked about in the first example, would be a retest of this 449.49 level. However, in this example, what we see is Once we start playing out this trade, there was no retest rate. We see strong price action, and price action is really what shows you what's going to happen on the chart. We see strong buying action right below that level. What does this mean? This means sellers came in very aggressive here and they bought the breakout, but buyers came in even stronger at that support area, and we broke back into that level of support. And now look at this candle that we're printing. We're retesting that support level with a hammer candle. The hammer candle indicates that sellers try to bring the stock down. However, buyers still closed it above the support level. This is a great example of a fake out trade. This is where we can enter in for the fake out, right? Because this is a very low risk trade. We can risk low of day here because if we do break low of day, that means sellers have won this trade, and we can target high of day because that's where buyers want the stock to go. You have to understand where the most liquidity is sitting, and that's at high of day and low of day after this fake out. This would once again give us a 4.0 risk to reward trade. Let's enter into the trade here and see exactly what happens. There we go. Also, at the same time, when we broke that resistance here, you can see when we were talking about that support and resistance liquidity, we also got an example of the retest on that resistance liquidity, right? We see that with that hammer candle at 1204 right there, right? We see that with this hammer candle at that 1204, we broke and then we retested and then we made new high of day. So there's a lot of liquidity sitting at these areas. And in this example here, we made $1,070, a 4.0 risk to reward. This means we would be risking $267.50. So I hope these 3 liquidity concepts will help you in your trading when you're looking to enter a trade and don't understand where liquidity is sitting or where the best entry on the trade is possible. If this video helped you, make sure to leave a like on this video. If you have any questions, put them in the comments down below. Make sure to follow me on Instagram and Twitter, and I'll see you guys next week with a brand new video.